Hi, I'm Shane Begg with Manna Group, and today I'm going to spend some time talking to you about lending and pre-approval / pre-qualification for purchasing a home. This is a really important step in the home buying process, speaking with a trusted lender to understand what you qualify to purchase. We commonly think credit score is like one of the most important things. We think, oh, I have a low credit score, so I can qualify to buy a house. That is only partially true. Probably the biggest matrix and most important matrix is what they call debt to income ratio. So your credit score will affect you on what you can qualify for. More importantly, it'll affect how high the rate of what you qualify for. So if you have a very low credit score, you're viewed as a more risky borrower, and lenders will charge a higher interest rate for that risk. If you have a higher credit score, typically speaking, you'll get a lower interest rate. So your credit score is very important. But how lenders typically figure out how much you qualify to purchase is through debt to income ratio. And what they do is it is really quite simple. They take all of your income, so you make money from your job, you have investments that make money, you have alimony, any kind of income that you have, they take all of those and they put into a formula. Some income, if it's variable, they have to take averages. But for your average purchaser, W-2 income, they take it before taxes, and they say, okay, your income is, we'll say $10,000 a month for an easy number. And then they calculate all of your debts. So they want to know, do you have a car payment? Do you have student loan? Do you have credit card debt? Any kind of debt that you're obligated to pay on a month-to-month basis, they subtract that from your net income, so your pre-tax income. So if you had credit card debt payments of like $250 a month, you had a car payment of $500 a month, and then say student loan payments of $250, all of that would add up to $1,000 of debt every month that you have to pay, or they'd say service every month. So they take that, they take $10,000, and they subtract the $1,000 of debt, and you're left with $9,000 that they would say is usable for your mortgage payment. I would say a healthy rule of thumb is to use a third of that balance of income towards your mortgage payment. So in this scenario, $9,000, a third of it would be $3,000 is a reasonable housing payment. Many types of loans will allow you to push that debt to income ratio, not from all the way up to just below half, so like 49.9%. VA loans, I've seen people even push it further. I've heard of loans that were in the 70th percentile. That's not something I would financially recommend. It's just how the process works. Again, I would recommend staying around the third as a really healthy ratio to use. So if you take it and continue to work that backwards, you say, I have $3,000 that's good for a payment. Right now in the market where everything is at, I would say you could factor pretty healthily $800 a month for every $100,000 that you borrow, or $80 for every $10,000 that you borrow. So if you have a house that is $300,000, that'd be 3 times 8, which is $2,400. So that would be under the $3,000. You could afford it. The absolute cap would be another $400 a month. So it'd be $350,000 in purchasing power. So this is where you get a lot of lenders talking about if you have a car payment, that takes down your purchasing power by X amount. You can see $500 would be close to $60,000 to $70,000 in purchasing power. And that's how they work those ratios to understand your debt to income ratio and what you truly qualify for. It gets quite a bit more complicated than that. Those are the rough matrix, the important inner dynamics. I'd love to talk to you more. If you have questions, feel free to reach out.